We watch financial news, listen to expert advisors, expecting them to be perfectly rational, almost robotic. They manage billions in capital, predict market shifts, and guide our critical investment decisions. But then we see experienced investors make seemingly basic errors, or fund managers cling to failing assets long past reason. It leaves us wondering, how can someone so smart, so steeped in data, fall into such obvious traps? This isn't about incompetence. It's about the very human brain at work, even when dealing with millions. The answer lies in something we all experience: cognitive biases. These are systematic patterns of deviation from norm or rationality in judgment. In finance, where precision and objectivity are paramount, these subtle mental shortcuts can derail even the most sophisticated strategies. Experts aren't immune. In some ways, their deep knowledge can even amplify these inherent human tendencies, leading to costly decisions. We're going to explore how our own wiring can mislead even the sharpest financial minds. One of the most insidious traps is confirmation bias. This is our brain's tendency to seek out, interpret, and remember information in a way that confirms our pre-existing beliefs or hypotheses. For a financial expert, this could mean focusing only on market reports that support their bullish outlook on a particular stock, or dismissing dissenting economic analyses that challenge their initial investment thesis. The more time and effort they've invested in forming an opinion, the stronger this bias becomes, impacting portfolio management. Imagine a fund manager who spent months researching a company, building a strong case for its growth. They've presented it to their team and clients. Now, when new, negative data emerges that casts doubt on that company's future, their brain might unconsciously downplay its importance, or interpret it as a temporary blip. They might double down on their position, convinced they're simply buying the dip, when in reality, they're filtering out critical signals that could save their capital. This isn't about being wrong. It's about avoiding the uncomfortable feeling of being wrong. Then there's overconfidence bias, a common pitfall across many professions, but particularly potent in high-stakes environments like investment management. This is the unjustified belief in one's own abilities, knowledge, or judgment. After a string of successful trades or market predictions, an expert might start to believe their intuition is superior, leading them to take on excessive risk or disregard proper due diligence. They might dismiss market warnings or counter-arguments because they truly believe they know better than the general market. A seasoned analyst, after correctly forecasting several market shifts, might become overly confident in their next prediction. They might allocate a disproportionately large portion of capital based on this single, strong conviction, bypassing standard risk management protocols. When the market behaves unexpectedly, this overconfidence prevents them from adjusting quickly, turning what could have been a minor loss into a significant hit. The very success that built their reputation becomes a dangerous blind spot. For a financial professional, this could appear as holding onto a severely underperforming stock, not because they believe it will recover, but because they've already spent so much time and effort researching it, or because admitting failure would be too painful. Consider a real estate investor who purchased a property at a high price, believing in its future appreciation. Months pass, the market shifts, and property values in that area decline. Despite clear indicators that the initial investment was flawed, the investor might refuse to sell, citing the lost money they'd incur. Instead, they might pour more capital into renovations or marketing, hoping to turn it around, further escalating their losses in pursuit of justifying the original decision. This traps valuable resources and compounds risk. What makes these biases so tricky for experts isn't just that they exist, but that the very systems designed for analysis can inadvertently strengthen them. Sophisticated models and deep data dives can provide a false sense of certainty, making it harder to question initial assumptions. The pressure to always be right, to maintain a flawless track record, and the competitive nature of finance can also amplify the human desire to confirm, to be overconfident, and to avoid admitting past errors. It's a subtle interplay between human psychology and strategy. So, how do we combat these deeply ingrained tendencies whether we're managing our personal savings or multi-million-dollar funds. The first crucial step is building robust frameworks. This involves creating a clear thesis before entering a position, outlining specific conditions under which you would sell, regardless of current emotions or sunk costs. It means having an exit strategy before you even think about an entry. Another powerful tool is structured dissent, actively seeking out opinions that contradict your own. This isn't just about hearing no. It's about finding credible arguments against your current financial strategy. Some investment firms employ devil's advocates, whose job is specifically to poke holes in proposals. This forces a broader perspective and can reveal blind spots before they become costly mistakes in capital allocation. It strengthens the analysis. Finally, cultivate a mindset of intellectual humility. This means acknowledging that uncertainty is inherent in markets, and that even the most rigorous analysis can be wrong. Regular postmortems of past decisions, both good and bad, can highlight personal bias patterns. Keeping a decision journal can track the rationale behind every significant choice, allowing for objective review later, separating outcome from process. This approach builds resilience. The takeaway isn't that financial experts are flawed, but that they are profoundly human. Their sophisticated knowledge and tools can sometimes make them more susceptible to certain biases, not less. By recognizing that these universal cognitive traps affect everyone, from the novice investor to the seasoned fund manager, we gain a crucial advantage. We can then build defenses, not just against market volatility, but against the hidden pitfalls within our own minds. Understanding these biases isn't about avoiding mistakes entirely. That's an impossible goal. It's about reducing their frequency and severity. It's about creating a more resilient approach to managing our wealth, grounded in self-awareness rather than blind confidence. If even the sharpest financial minds must actively fight their own wiring, what steps can we take today to make our own financial decisions more rational, more robust, and ultimately more successful?